A Texas contractor sits in his truck in late March 2026, staring at a permanently frozen business banking app. Thousands of business owners across the state are discovering that their community banks and credit unions have simultaneously locked their digital gates. Local branches are shuttered, their glass doors padlocked against the growing crowds. In the financial districts of Dallas, the silence is absolute. The paralysis extends through the energy corridors of Houston and down the Gulf as the regional banking network goes dark. After years of mounting tension, the modern Texas bank run has officially begun, leaving the state's commerce in a state of sudden arrest. Local business operations have stalled because the digital ledgers that facilitate every transaction have stopped updating, trapping capital inside a non-responsive system. To find the root of this insolvency, we have to look past the frozen apps and into the underlying assets of these regional lenders. These banks operated on a temporal liquidity mismatch, taking short-term customer deposits and placing them into long-term, illiquid physical assets. Over a decade, regional banks financed miles of luxury office space and suburban build-to-rent projects that now suffer from record-high vacancy rates. While national megabanks reduced their risk, local institutions absorbed the bulk of the commercial real estate exposure just as the market began to turn. This chart clarifies the systemic risk. While Tier 1 institutions have minimal commercial exposure, regional Texas banks are burdened with 80% of these high-risk loans. Shifting labor trends and high interest rates caused these properties to lose value, leading to widespread defaults that exhausted the bank's capital reserves. These community banks were tethered to trillions in worthless concrete, rendering them functionally insolvent months before the public lost access to their accounts. The Friday morning lockouts were the result of a coordinated capital flight that occurred during the preceding 72 hours. Modern bank runs no longer look like the Great Depression, with crowds of people waiting on sidewalks for physical cash. Institutional investors moved billions through encrypted treasury portals while the public slept, emptying the vaults before the first branch opened. Large corporations and venture capitalists utilized advance warnings of the bank's crumbling balance sheets to secure their positions early. This chart reveals a sudden surge in capital outflow. Over 3 days, institutional whales triggered automated protocols to wire massive sums outward. As the red line crosses the liquid reserve threshold, these regional banks are stripped of operational cash, leaving them completely hollowed out. The wealthy moved their assets at the speed of fiber optics, leaving the average depositor trapped in an institution that had already been drained of its liquidity. This collapse falls heaviest on the small businesses that serve as the state's economic foundation, from HVAC contractors to local restaurants. These companies rely on cash flow velocity, meaning any interruption in their ability to pay workers or suppliers leads to immediate operational failure. Many small business owners believe their funds are safe because they are federally insured for up to $250,000. While the insurance is real, federal receivership creates a massive bureaucratic bottleneck that delays the release of funds during a systemic, multi-bank crisis. In a collapse of this scale, the government requires weeks to audit ledgers and verify accounts before a single check is cut to a depositor. A 3-week delay means missing mortgage payments, losing supply lines, and defaulting on commercial leases that keep a business in operation. For a company living on tight margins, a bank failure on Monday leads directly to a business bankruptcy by Friday afternoon. The government guarantees the balance on the screen, but the administrative delay makes that safety net ineffective for saving a business in real time. Following the freeze, federal regulators must legally dispose of the remaining assets held by the failed regional banks. These institutions are auctioned off in emergency proceedings intended to stabilize the broader economy. Only the largest Wall Street megabanks have the cash reserves required to absorb these failed portfolios during a period of extreme market volatility. Financial titans acquire the regional assets and customer data for pennies on the dollar, consolidating their control over the local market. These acquisitions are often subsidized by federal guarantees, allowing the largest banks to expand their footprint with minimal risk to their own shareholders. The physical landscape of the state changes as community bank signage is removed and replaced by the corporate branding of national monopolies. The era of the local Texas banker, who possessed first-hand knowledge of the regional economy, has been brought to an end. small business owners must now rely on rigid algorithms managed by executives thousands of miles away to determine their creditworthiness. This shift represents a permanent loss of regional control over the wealth generated within the state. The 2026 crisis transferred the state's regional wealth from Main Street directly into the vaults of Wall Street monopolies.